hard. Rich, I'm liking all of your Christmas signs and posters behind you.
Thank you. Yeah, it's a little sad to me. It's all gonna have to come down pretty soon, I can't have the Christmas background in like late January, so
Yep, I get that.
this November and December just flew by for me for
Yeah.
a bunch of different reasons. So little surreal, hard to imagine that, yeah, Christmas is 4 days away. Crazy.
I'm not ready for that. I mean, it's coming whether I'm ready or not, right?
Exactly. So good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative here with the final last week in Mortgage Today of the 2021 year. It's been quite a run. We've done this show. I've only taken off a few, 2 or 3 Tuesdays, I think, this year. So it's been a lot of fun getting a chance to have discussions with some people like Melissa. I've been in the co-host seat multiple times, but probably had 35, 40 different co-hosts this year. So always great to pick the brains of our smartest lender members. It helps me stay dialed in to what's going on with the broader mortgage industry, and lucky to have one of those very brilliant leaders with us again today to conclude the year. The Chief Mortgage Officer of Right By You Mortgage and TMC Board of Directors member, Melissa Langdale. Melissa, great to see you again.
Yeah, great to see you too. I think you might have oversold me a little bit, but happy to be here today and help in any way I can.
Awesome. Well, this December, there's been so much news, mortgage news. You helped do the year in review session for the 12 days of TMC event that we did. And we did that session on Friday. And as I was putting together the chronological listing of all the big news that happened in the mortgage industry, December, there's been a lot of stuff that's happened, from the the official nominations of some key leaders in housing, the Better.com Zoom fiasco, CFPB came out with some supervisory findings, and then a lot of stuff that's happened also in the last week that we're going to get into today. But it's been a wild year. It really has. There's been a lot of action.
It has, for sure. It's definitely been a wild year. It's been a wild 2 years though for the mortgage industry, right? It's our industry has been through a ton of change with COVID and the added layers of risk that's happened, and then all the volume that's come as a result, and then inventory shortages and builder supply chain issues, and it's been kind of a rolling several years of consistent pivots, right?
It has. 2020 was really defined by the pandemic. We all remember the chaos that ensued in March and the fear amongst mortgage lenders, our members, of all the uncertainty. And then it was just like, oh my God, it's so busy, for the rest of that year. And then this year, you mentioned a lot of the really unique things that happened with the business climate this year. And then we had a lot of stuff. This year really, to me, was defined in a lot of ways by the change in presidential administration, new appointments and new direction for FHFA and CFPB, and leaders like yourself. You got to stop on a dime and pivot, because a change in presidential administrations, it really dramatically changes the outlook for our industry and things that leaders like you have to be focused on.
Mm-hmm. It does, for sure. It's, this administration has a heavy focus on affordable housing and racial equity and, in housing. And so there's a lot that we're going to see, I think, coming down the road as these appointments get to really start implementing some things that this administration is really holding dear.
All right, let's get into it. So the news of the last week, there was quite a bit of it, and we'll get into it. But FHFA with some news once again, putting in place a proposed capital planning rule for Fannie and Freddie. Essentially, putting in place rulemaking and framework that would ensure that the GSEs report out on their capital levels on a regular basis, and make sure that they are at the appropriate capital levels. Also, there was some news this week in the FHFA GSE world that Freddie Mac missed their low income refi goal. 21% of the broader mortgage market nationally this year, low income refis, and Fannie came in at like 19.5%. Fannie came in at or above it, but it really, I think that the theme of both these pieces of news is that, in addition to FHFA wanting to use the GSEs more aggressively to pursue their housing goals, they're also going to do something that hasn't been done really ever in a long time with the GSE since they went into conservatorship. And that is holding their feet to the fire on goals and metrics that they lay out. And I think that's one thing that's been clear in listening to Sandra Thompson speak is, they don't just want to set goals for Fannie and Freddie, but they want to make sure they hit them. And if they don't, they want to have action plans to make sure that they can meet their objectives. So a big change from FHFA, GSEs, and government mortgage buying.
Yeah, I love both of those strategies. I mean, I think it's important for the GSEs to manage capital. Obviously, that's important for all of us. And then kind of FHFA holding their feet to the fire is going to help position them to be better GSEs, right? I think that framework is going to help them, as they look into the next year. But as you mentioned, the low income and affordable housing goals that have been set, there's additional provisions there. They had an extra. I'm looking at the article real quick, but they actually had an extra provision in there that had two single family purchase sub goals. One was to target low income neighborhoods and the other one was to target minority communities. And so it's not just kind of did you meet your 21%, right? It's now taking it even further. Are you reaching the right targeted communities? Are you in enough minority communities? Are you in enough low income neighborhoods? And they're increasing in addition to that in 2022, the percentage that's required. Fannie and Freddie this past year were kind of held accountable to that 21% of the loans that they have been in that kind of low income category. That's increasing to 26% in the coming year too. So, this administration's, focus on racial equity and home affordability and reaching those lower income borrowers is coming out in all of these things, right? We're seeing some of that kind of take action. So it'll be interesting to see how Fannie and Freddie try to reach that increased goal in 2022.
Yeah, it seems like a lot of make sense stuff from FHFA and Sandra Thompson also this past week, formally nominated as the permanent director of FHFA, which I think most of us in the industry applauded, cheered. She had a chance to speak virtually at our conference we did in September. And I think everybody was really impressed at just her forthrightness, her handle on the issues most important to the industry and to mortgage lenders. And I've just heard many anecdotes about her, including I think Rob Krisman mentioned it on the show I do with him on Fridays this past Friday that, he had emailed her to congratulate her on the nomination and emailed her right back, within 5 minutes. That never happens with housing leaders, right?
I do think, you're right. It never happens. I would never have expected that. But it just shows her commitment to the industry. I think, she's going to be a good advocate, I think, for our industry. I think she does balance safety and soundness with, some of the administration's goals as well. So, I applaud her being appointed, and it'll be fun seeing her get her hands in everything as she gets fully into the role.
Yeah, been no shortage of news and announcements from FHFA and CFPB, the new iterations of both departments, and CFPB made some news as well this week in tandem with DOJ, putting mortgage servicers on notice about some complaints that they'd been receiving from veterans just on payments on loans and statement mishaps. And, I think the broader picture here is that CFPB, they're really focused on fair lending demographics, serving those that have not had as good a chance to achieve home ownership, and mortgage servicing, making sure that borrowers that are struggling to make payments, have every opportunity to be worked with and to develop solutions. So I think that was really the two themes I saw from CFPB this year, and but certainly a different regulatory climate for mortgage lenders as we move forward.
Yeah, the CFPB is, the article this past week was really about service members, but in general, they have been, there's been lots of activity and around servicing in general, and how lenders are handling forbearance, and this kind of putting mortgage servicers on notice to veterans complaints is important. I mean, there is a civil a service member. I can't speak today, Rich. I'm so sorry. A Service Member Civil Relief Act, that protects our active duty military. And, it's important for us in the industry, those that have a servicing platform, to understand what that is and to make sure that they're adhering to it completely. And they've mentioned a few times at CFPB this year in all sorts of ways that they're really going to be focusing on servicing, how, like I said, how members or how mortgage companies are monitoring servicing and handling forbearance, as well as obviously now the Service Member Civil Relief Act.
This is the last week in Mortgage Today, the final last week in Mortgage Today of the 2021 year. And I want to thank all of our listeners, most of them on podcast. We also do this live and post this to our YouTube, but really have had a lot of fun this year, keeping tabs on the mortgage industry each week with great leaders from our network. And this week, joined by one of them, the Chief Mortgage Officer of FIU Mortgage, Melissa Langdale. And Melissa, more news, another entity that made a lot of news in 2021, Rocket Mortgage, all kinds of stuff happened with them, their stock and the feud with UWM, and, getting into some different business lines. And they made some additional news as they closed out the year. And this was the acquisition of Truebill, which is a financial services app that they bought for just under 1.3 billion. I know, just in listening to some analysts' take on this, some felt like they may have overstepped here and overpaid a little bit. Some people are like, Truebill, I had not even heard of this, 1.3 billion. But I think where they're going with this is getting into financial services, and a lot of people managing them on their phone right now. And I think the ultimate end game here is like to be able to pre-approve mortgage customers before they even apply. If you listen to their CEO, Jay Farner, talk about this acquisition, seems like this is the direction they're going. And, made a lot of jokes all year about all these public mortgage companies that have seen their share price struggle, and just the plight and difficulty of being a public mortgage company because of the margins and the cyclical nature of our industry. But it does feel like Rocket is starting to put it together with all these different sticky types of add-ons to their business. If it's title, if it's realty, if it's financial services apps, they no lack of trying. They're being very aggressive. So
they are, yeah. This whole Truebill acquisition is really interesting to me. We talked about consumer expectation shifting really as a result of the Amazon effect originally, and then COVID hit, and that whole thing went out the. It just went crazy, right? As everybody's ordering things on their phone, like there's an opportunity to not walk into a store is growing, right? And if I can order something on my phone and have it delivered in 2 hours, right? Why in the world does it take 30 days to get through the mortgage process, right? So, those things, those consumer expectations are kind of shifting right now. And so I think this is Rocket's kind of way of saying, hey, we're looking for a way to serve more holistic needs of our customers. And so it's really interesting to me. I'm curious if it will, keep moving consumer expectations for us as an industry. That app really, because it deals with building budgets and improving credit scores and those sort of things. It's very geared towards first-time home buyers, right? And kind of those younger borrowers that may need help with creating some of those things. So it will also be interesting to see if this can be, even taken further to underserved markets, and help them to fulfill an additional need there too. So I think it's definitely an interesting twist, but I think, again, it just goes back to serving kind of holistic needs of customers. I think as an industry, that's what we all try to do, but they're getting their hands in ways to actually, pull it all together.
Yeah, and I remember also at our conference in September, we had some Wall Street guys there speaking that were focused on like the mortgage and the mortgage fintech space. And I think that was one of their takeaways, just having that cold, calculated outside look on the mortgage industry. Like the lenders that will be successful, especially the public ones, will be the ones that can bolt on all the other services, to the mortgage. If it's the title, if it's the real estate transaction, if it's other homeowners insurance, whatever. And that's clearly the direction Rocket's going. I had a chance to hear their CEO, Jay Farner, speak yesterday on CNBC. After this, and they're in like disbelief that their stock is in the 14s. Like that's all he could talk about is how undervalued it is, how people just can't see their value, and that they're creating value in different ways, and how they're buying all these shares back because they can't believe what a deal it is. It's kind of funny, but it's a wake up call. It is very, very difficult to be a public mortgage company. It's a reason that there have been very, very few to little of them in history. So
yeah, I agree.
Moving on, Alana McCargo confirmed as president of Ginnie Mae, the first time we've had a Ginnie Mae president since 2017, which is really hard to imagine.
It is crazy that we've gone that long without it. I'm definitely applaud the agency taking that position to have an actual permanent president. It's surprising to me that it's made it this far without having that kind of direction. Yeah. And
then, I hate even talking about it because it's so annoying to me, but the never ending pandemic and the latest variant, of course, making news and of course, impacting our industry, impacting lenders like you guys and all across America that are, we're come bringing workers back to the office now that the numbers are back up, and the interest rate climate as well, is impacted by it in different ways. And seems like rates have actually gone up. They fell initially, once the variant was kind of announced that it was making its way around the globe, but seems like rates have crept up a little bit these last few days. But refi is clearly bleeding off, right? As we get towards the end of 2021.
Yeah, I mean, obviously, as Fed has announced they're going to start their tapering earlier and faster, right? We're going to see rates continue to go up, and anytime that happens, right? If you were able to refinance it, the upper twos, or shorten your term, what's really your opportunity going forward? And so those rate term refinances that we've seen be a big part of our industry over the last year or two the opportunity is just naturally going to go away, or diminish. I won't say go away, diminish. There's always going to be a need for cash out for various reasons, right? Renovations or, anything like that. And obviously the purchase and construction market is where most people are focused going into 2022. You look at all the things that are affecting that world though, right? You've got supply chain challenges for builders. You've got inventory shortages for the purchase market. Those things in addition to rising rates is going to cause eventually some affordability issues for our younger buyers and first-time home buyers. So, we've got a lot of challenges going into next year, and just being able to, keep the volume up as all of our lender members, I'm sure, are thinking about right now. How do you keep the volume up when you have those kind of challenges, facing your purchase and construction worlds?
Yeah, that's a good segue to how I wanted to use the rest of the time on the show today, is just to kind of look into next year and, start to think about the landscape. You go back to a year ago from today when we were trying to forecast what 2021 would bring. It definitely wasn't 4 trillion plus in business. Most people were projecting 2.6, 2.7, 2.8, a big drop off from, I think it was 4.4 that we saw in 2020. But as we look into next year, I think some of the themes that, is really this equity, so that we have had so much home price appreciation. Homeowners across America are sitting on mounds of tappable equity, with the pandemic still wreaking havoc in a lot of ways, and an economy that is improving in some regards, but is still pretty uneven. And I think that's just going to be one of the themes of this year is, that piece of it. To what degree will the interest rate climate plays a factor in how many cash out refinances you're going to have. If rates go up to 4%, it obviously makes it less viable. But the home equity market, depositories like Fidelity Bank, which right by you is the division of, you can offer equity products in most cases to your borrowers. But independent mortgage banks, which now comprise probably about 2/3 of the business, the mortgage business in America, they don't really have good standalone home equity products for that homeowner that's sitting on a 30-year fixed rate at 2.5, that is not going to want to refi that thing into 3.5. If they have to, they have to. But I think they're really going to look to that standalone HELOC. And we're starting to see, like with our tech fund, TMC's Emerging Technology Fund, we've looked at more than one technology provider solution that's trying to get out in front of this, that sees this opportunity with standalone HELOCs, and heard some murmurs of secondary market players that could, potentially get out there with some standalone second mortgage products up to sane LTV. But how do you view that market, just that issue, tappable equity, cash out refis, home equity loans? I see it being a big theme of the year ahead of us.
I do too. And I think because of everything you just mentioned, we're also going to see an increase in renovations, right? If I can't find a new house to move to, I'm going to fix the one that I have, right? And people looking for opportunities to tap into that equity to do it in a way that is the most beneficial for their family. And equity lines, are generally really beneficial for that. Because again, they don't have to do anything with their first, right? They can keep that 2% interest rate that they have and just tack on to it with a second. I think we're going to see more and more of that. I think, like I said earlier, we're going to see more renovations, people staying in their homes and just doing add-ons. I think all of that is going to come into play next year.
Yeah, absolutely. And, another very pertinent issue for mortgage lenders, leaders like yourselves, is just the staffing issue. We've seen volume drop off as we were leading into Thanksgiving, refis bleeding away. But, we chronicled on this show, I remember talking about in October and November, reports from self-serving real estate sources, Redfin and Zillow. Oh, there's going to be a slew of homes put on the market. Surveys of customers indicate that ridiculous percentages are planning on listing their homes over the holidays. Well, that really didn't happen. Then you had the Megatron variant, or whatever the hell it's called, and that does not help with home sales and home tours, obviously. And so we go into next year. It's been a good year for mortgage lenders, a profitable, solid year, but the future looks uncertain in terms of being volume, getting, anywhere near the levels that it was for the last year and a half. And tough decisions for mortgage lenders, because, most people are overstaffed right now. They're making those decisions. Do we Can we grow into it? Can we recruit? A lot of lenders are pursuing recruiting initiatives, if it's M&A or and it's, you don't want to let people go when you have that stuff going on. At the same time, it's tough to count on growth in a lot of times. So your thoughts on that seesaw?
Oh, between staffing and recruiting and kind of strategy for the coming year, huh? So it's, we worked really hard as volume increased to make sure that instead of over hiring, we really looked at ways to keep our team at highest and best use and supplement things underneath them that we knew were going to be more temporary resources. And so, I know we're not alone in that strategy. There's been a lot of lenders that have taken a similar approach just to make sure that they're navigating this the right way for their associates and for their organization long term. So staffing, I think, is always a big challenge or a big question mark in our industry because it can be so cyclical. And we did just come through a unicorn year and a half, right? And so it's I know everybody's looking at those sort of things. You're looking into next year and volumes. I do know a lot of lenders that are looking at recruiting strategies. I also know a lot of salespeople that are looking for opportunities because because of various reasons, right? So I think we're going to see some aggressive recruiting strategies coming into the next year as lenders try to hold on to volume, but we're really focused on purchase in construction mortgage loan officers. I think that would be a focus for any lender out there, making sure that they're hiring the right people to help them to grow in the right ways.
Absolutely. And just a couple minutes left in 2021 for the last week in mortgage today, but you hit on a couple of other things I wanted to throw out at you as potential themes for 2022. New construction and lending in and around that. Seems like lenders are all hyper focused on like the e-close thing. Like I'm ready to just, get it done, get it in the rear view, not like crazy borrower demand for it, but there's efficiencies with it. And it's just something we're going to need to put in place. Automation of tasks in general. A lot of the automation that we saw come to the front end, the borrower experience via apps and point of sales, that we're seeing it with the tech fund as well. Like that stuff's coming quick. The automation of task piece, non-QM forever has been talked about as a product that could be emerging. I think you'll see more of that this year, but anything in there that really has your attention as you head into the new year?
Well, non-QM has spoke to us, especially during COVID, right? We created a portfolio product for business owners that really has helped us to better serve our customers. So that has been something that's helped us throughout, the past year. I do think that most lenders out there, to your point on those different strategies of bringing more tech into what they're doing, but whether it be e-closing or a better POS platform or, kind of consumer experience platform, as some of them call it, those things really are designed to create efficiencies. So back to kind of the staffing issue, right? That staffing question is, how do we create efficiencies? How do we simplify the process for our customers to the extent that it creates a great experience? I still think there are a large majority of customers out there with that when you say mortgage kind of have a visceral reaction. Like there's, oh gosh, I have to go through that. I just want a house. And so I think that that's fantastic for our industry. I think we all should be thinking through those things that help us to create a better client experience. To make things easier on people as they go through the process. We shouldn't be having, as an industry, having a visceral reaction for customers or people walking away at the end of the day going, okay, well, they didn't ask for a blood sample. So I think in general, we're okay here. I did okay at the end of the process. It's, I think it's our obligation as an industry to look for ways to create a better client experience, but also to create some efficiencies for our organizations as well. And everything we just mentioned does those two things. So I'm excited to see where it takes us.
Very poignant words to take us into the new year. And I just want to thank you so much for everything this year, for co-hosting this show multiple times, all the various virtual sessions you led or helped lead this year, for joining our board. It's really been awesome getting to know you over the course of the last few years here, and wish you and yours a Merry Christmas and Happy New Year. And thanks so much for everything this year.
Thank you so much as well. I hope you guys have a very Merry Christmas as well.
And to our viewers / listeners, thank you very much for joining us this year. We're going to keep this train rolling right into 2022. Same time, same place, every week, 2 p.m. Eastern, every Tuesday, the last week in Mortgage Today. Until next week, have a great rest of the week and have a Merry Christmas, everyone. Take care.